Good afternoon, ladies and gentlemen. And yeah, thank you for your time. Thank you for taking the time out to join GM Investments. This is our annual investment conference. And yeah, sadly, we don't get to see you in person yet again. So it's our second virtual investment conference. And hopefully this time next year, we'll be able to meet in person. It's convenient being able to host the investment conference wearing my shorts and slippers. But it's a lot more fun being able to engage with clients in a less formal setting than, kind of a Zoom setting where it seems very impersonal. So just in terms of proceedings for today, I'd like to share the agenda. So I'll be doing a short presentation on my side. After that, I'll hand over to Johann else. Johann is the chief economist at Old Mutual. And Johann will be giving us a local and global economic outlook. And we'll then say goodbye to Johann. It's a very important day in the life of any economist, nevertheless a chief economist, where the Monetary Policy Committee will be making an announcement on interest rates and kind of sharing their views on the economy and the inflation path over the coming few quarters. After Johann, we'll have Richard Simpson, who's co-founder of Obsidian Capital. Richard will be drilling down into markets. So while he may touch on some economic aspects, focus of his presentation will be more on so what from an investment perspective. I've got client money, where do I put this money? How do I invest it? And yeah, once we're done with Richard, that will be the end of this year's conference. So keeping it a bit short, recognizing that, we're sitting for extended periods and that in itself is not good for us. So we don't want to prolong the investment conference. So just from our side, I'd like to do a quick business update. And then I would like to talk about just what we're seeing as the COVID crisis continues to sort of unfold. We had the initial crisis. There were certain lessons that we learned from that point. But as the crisis continues and unfolds, we are seeing new challenges popping up that we need to respond to as a business and as professional advisors. So from a business update, I think just off the bat, GMI continues to grow from strength to strength, and we really have our clients to thank for that. A lot of our growth has come from the support and the continued support that we receive from clients. You continue to refer us, you continue to engage with us, give us ideas on how to grow the business. So we appreciate that. From our side, from a management perspective, deciding to bulk up the back office first has started paying dividends. We're seeing fewer sort of errors creeping into the system. We're seeing a lot more efficiency. And the feedback that we're getting from clients is that things seem to be working a lot better. So the foundations for growth have been laid. We continue to grow externally or sort of physically. So sorry, I was just putting myself on a different part of the computer there. The Cape Town office has grown to 4 staff now, and we are hoping to find 2 more candidates to fill that office. There's been good growth coming out of Cape Town, and we need to continue to support the business down there. As some of you may be aware, we we closed down the Durban office last year in response to the challenges presented by COVID. Now that we have a better grip on working like this, we can look at efforts at reopening that branch and supporting growth efforts down in Durban. Some of you may be clients of our short-term insurance business. That business has been a beneficiary of COVID, in that, when we started that business, we deliberately made it an independent brokerage. So the business has over 40 agencies, and as a result, they're able to source quotes for clients from a wide range of insurance underwriters. And that has helped in terms of bringing premium down and being able to be competitive in the market. So people are looking for ways at tightening their grip on expenses. Our short-term insurance business has benefited from that. Another COVID-related sort of trend is our fiduciary services business, which we started last year or the year before. There we've now drafted over 100 wills for clients, and that has proven to be a key issue in this COVID environment that we find ourselves in. So if you're looking for your will to be reviewed, you drop us a line. We could assist you on that front. And then just from an investment perspective, the business is called GM Investments. It is the core part of our business. We've continued to see assets grow on that front. So now we manage just over 1.7 billion of client money. And we always have to remind ourselves that it's client money, and that we have a fiduciary responsibility when it comes to investing those funds. Of the 1.7 billion, just close to 500 million is invested in GM funds. So you may recall from the previous two investment conferences, we took you through the process of our plans around launching model portfolios and then converting those portfolios into collective investment scheme funds. So that continues to grow. And again, thank you for your support on that front. Just two awards that we've won this year. Well, two surveys that we've entered. As we've done since 2016, we entered the Intellidex Financial Male Wealth Management Survey. And this year we qualified for 7 categories. And in those categories, we finished on the podium in all 7 categories. Virat Jagai, who many of you may have dealt with or know. Virat won top financial advisor or relationship manager, as they call it. So that was based on the feedback from clients. In terms of the different investor types or client types, so lump sum investor, young professional, successful entrepreneur, and wealthy executive, we produce perhaps the most consistent performance ever seen in this competition, where we ranked second in all 4 categories, and that's second out of 18 firms that qualify for those categories. So we were quite proud of that. We were second to different firms as well. It wasn't like there was another firm that had a whole lot of firsts there. It was, second to this firm and that firm and that firm. So it was a bit frustrating, as it was unfolding. But upon further reflection and just engagement with other people in the industry, it was pretty solid performance that we're proud of. And then from a overall perspective, we ranked second. Surprisingly, we thought we'd finish first given all our seconds. But yeah, that's how the scoring system worked. And then people's choice in terms of client feedback and client satisfaction. We ranked there. So we were quite proud of that. We also entered the FPI approved professional practice of the year survey, and there, unlike the wealth management survey, only professional practices so that have been approved by the Financial Planning Institute can enter this particular award. And yeah, last year we entered, we made the second round, but didn't quite make it as a finalist or on the podium. This year we were on the podium, but also went one better and managed to win the overall award. This award looks at the practice and how we run the business, our HR processes, our business policies, governance, compliance, all of those factors. So it's a bit different to the Intellidex award or the wealth management survey. But again, an award that we're incredibly proud of, and I think a big thank you to the team, and a big thank you to clients for continuing to give us feedback so that we know where to focus our efforts on. So what I'd like to do quickly is really talk about the ongoing impact of COVID from a financial planning perspective. Just need to move myself again. There we go. So what we are seeing, when the crisis hit, it highlighted issues such as the importance of emergency funding, having medical aid cover in place, having properly structured risk cover, well-diversified portfolio, all of that. Those were the lessons that tended to come from the initial COVID impact. But as the crisis continues, and you have other things happening like the riots in July and things like that, there are new issues starting to come up. And in fact, we are starting to see responses from different players in the market. And one of those responses is, COVID's had a significant impact on the reserves of life insurance companies. A lot of these companies had planned to pay out, depending on the size of those companies, between 2 and 5 billion in claims, and actual claims were coming out closer to double where they had initially planned or expected that they would be making payments. So the result of that is that risk pools have been significantly deteriorated. And so now insurers, the underwriting process and the underwriting cycle has been heavily impacted. And we've seen a significant increase in the cost of life cover. So that has a financial planning impact that, we need to be aware of. And where clients do not have life cover, we need to look at strategies there just to mitigate that particular issue. What we also are seeing is that, there have been a significant number of excess deaths in South Africa since March last year. So government expects a certain amount of people to die on a monthly basis, and that number ranges anywhere between sort of 9,500 and 11,500 people per month. But what we saw was a significant number of excess deaths above the top end of their estimates. So since March last year, there have been close to 260,000 excess deaths. And COVID accounts for 90,000 of those deaths. And you see the trend tends to go with the waves as well. So there's a clear impact from COVID on that. But what all these excess deaths do is that what they've been doing is putting strain on the master's office. And the master's office has been set up, to cater for anywhere between 9 and 11,000 people or South Africans dying on a monthly basis. And now they've had to, take on the workload of in some instances, 20,000 people dying in 1 week. So these impacts are starting to come through, and we're seeing that the master's office, things are taking a long time to come out of the office, is increasing. So what this is showing is that the importance of having a will and not dying intestate, so that's not dying without a will, has taken on new significance, because if you die without a will, then your engagement with the master's office is a lot more than if there was a will in place and you go straight to the point of appointing an executor. So again, we've seen it in our business with more and more people reviewing their wills and taking out wills. But what we're also noting is that it's starting to impact on people's investment portfolios. So people's discretionary portfolios, because any money you have in a share portfolio or in a unit trust portfolio, those funds are dealt with in terms of your will. So essentially, they are impacted by the efficiency of the master's office. I'm going to talk about that a bit later, because it's looking like we now need to start implementing strategies there to address that particular challenge. We're not through the crisis. I think Britain announced this morning or yesterday that there's a subvariant of COVID accounting for an increasing number of infections in the UK. I think it was about 12% of new infections are due to this new subvariant of the Delta virus. So we're certainly not out of the woods. So, maintaining medical aid is going to be a critical and ongoing thing. I think one that's perhaps out of our pay grade and our area of responsibility, but certainly impacts on what we do, is this issue of mental health. And I think just from our side, all we can do is ask people to pay attention to their mental health, their own mental health, and take very deliberate and active steps to maintain and manage their mental health, whether that's with specific interventions with a mental health practitioner, or whether it's just maintaining a healthy lifestyle and taking time out, playing your favorite music, things like that. That would just help you in terms of maintaining mental health. We're seeing statistics coming from the insurers of a mental health challenge that's going to be facing this country in the future. Some of it's related to COVID. A lot of it is just sort of compounding effects, or COVID has compounded a lot of challenges that were there pre-2019 or 2020 when COVID landed. From our side, what we've observed in the last 2 years is alternative investments paying off, and I'll talk about that. And then we've taken more questions from clients on the issue of immigration. And so what we've done is we've partnered with a firm that can answer questions around the issue of citizenship by investment options. So if you need any assistance there, we can assist, or we can at least put you in touch with professionals that have experience in this field. And then also look at the issue of, reviewing the structure of your life cover in the context of perhaps becoming a global citizen. We increasingly including dollar cover for clients, so that in that whole process of becoming a more global citizen, there's sort of dollar cover that comes into the estate and assists with any sort of immigration plans and things like that. So what I'd like to do is just take a closer look at the issue of the Master's Office. Just some background on the Master's Office. The Master's Office falls under the Department of Justice, and it's responsible for various responsibilities, including controlling and supervising the administration of these deceased estates. I think that's the part that keeps them quite busy, but they're also involved in terms of persons under curatorship and insolvent persons, and then the appointing and removal of trustees on various trusts. So the department doesn't only deal with deceased estates, they've got a significant workload outside of that. And besides dealing with a much higher number of deceased estates where they have to issue certain documents and letters of executorships and things like that, and approve L&D accounts, the Department of Justice experienced a cyber attack on the 5th of September. And that had a significant impact. In fact, that department came to a bit of a standstill for several days. In fact, things have gotten so bad that the Fiduciary Institute of South Africa, I think it was at the end of October, bemoaned the pace at which it was taking the Master's Office to expedite applications. And that's quite unusual that you'd have a professional body quite publicly sort of criticizing a key player within the industry or within government. But that's just on the back of sheer frustration from members, where you put in an application and you get absolutely no feedback for weeks on end, where typically there would be like a several-day turnaround in the past, and now it's taking weeks for any kind of documents to come out. So, as I said, you know, it reiterates the importance of having a will because it reduces the interaction with the master. But I think also just in terms of investment portfolios, retirement investments and retirement products do not fall under the ambit of the Master's Office. But if you haven't chosen beneficiaries, then those savings and investments will be paid into the estate and then will fall under the ambit of the Master's Office. So just critically, it's an admin issue, but it can save beneficiaries a lot of pain in the future. Just make sure that you've nominated your beneficiaries and you've submitted that paperwork. Your discretionary investments are where some of the challenges lie. And as I said, discretionary investments would be things like share portfolios, you know, any unit trust portfolios that you've got. Those form part of the deceased estate. And sometimes they are used for the liquidity requirements in an estate. So you may have wanted a share portfolio to go to your child, but it ends up being used to cover estate expenses. So what we are looking at, including a lot more in client portfolios and client solutions, is life-wrapped discretionary investments. Because with a life-wrapped investment, you are able to nominate a beneficiary. And in that instance, upon the death of the investor, the beneficiary can go and get the funds from the insurance company and doesn't have to deal with the Master's Office. You also save on executors' fees, so there's a fee saving there, but the beneficiary will be liable for their share of estate duty. But the important thing is that if that is an important source of funds for your beneficiaries, for your heirs, at least they're not waiting on an inefficient and incapacitated Master's Office to get their hands on those funds. Just to talk about life wrappers, I think more commonly known as endowment funds or sinking funds. There's some subtle differences between those two. They do have liquidity constraints. So you as an investor, you can make one loan or one surrender during that initial 5-year term. But with a bit of structuring, we can mitigate that liquidity issue. So instead of doing one policy for R1,000,000, you can do 10 identical policies for 100,000 Rand each. So that gives you sort of 20 opportunities to get funds from that portfolio if you do need those funds. They can be used to mitigate tax, so they have benefits beyond just avoiding the master's office. So they can be used to mitigate tax in retirement. Withdrawals from an endowment or a sinking fund are taxed as capital gains tax at a rate of 12%. So if your tax rate is higher than that, in that scenario where you now retire and you've got these investments still going, they can then be used as a tax mitigation option. The 5-year term vests on death. What that means is if you invest and during the 5-year period, the investor passes on, the beneficiary doesn't have to wait for the remainder of the 5 years to play out. And that's certainly the case with the sinking fund structure. And that's important because then the beneficiary has the flexibility to access those funds, how they need to access those funds. And then the other tax benefit is that there's no CGT payable on death. Dying is a CGT event. So your discretionary investments on the day that you pass on, there's a CGT event that is noted and included in winding up your estate. But these assets are excluded from that. However, when the beneficiary withdraws funds, at that point, the CGT will be triggered. And again, it's at a cheaper rate if you're a high income earner or a high taxpayer. Okay, I'm just going to talk very quickly, my last 2 slides, just from an investment perspective. What we've noticed over the last 2 years is that hedge funds in particular and alternative investments in general, we've seen have weathered the storm quite well. From our side, we've approved about 3 hedge funds for use in client portfolios. One of the hedge funds that we use, you hear from the fund manager today, is the Obsidian multi-asset hedge fund. The blue line here is the performance benchmark for that fund. The red line is the best performing unit trust, which has that benchmark as well. And you can see that just the kind of sheer, by way of having access to more tools to be able to drive return, hedge funds have been able to, in a very difficult environment, extract excess return from the market. And if you think back to 2015, 2016, around there, those were also sort of fairly difficult times in the market, and hedge funds then were able to extract excess return. You see that with the other hedge fund, the 361 retail hedge fund, which is different to the multi-asset. It's a long-short equity-only hedge fund. And benchmarked against the all-share index, you'll see that generally in times of market pullback, your hedge funds and well-managed funds are able to either protect capital or, in fact, give you a return in a falling market. So including those in client portfolios has become a lot easier since 2017 when the regulatory environment changed. So before that, we didn't use hedge funds at all because they were unregulated. And in terms of our license conditions, we were not offering them to clients. What they do offer is a different return signature to traditional investments. uncorrelated to markets, that markets can fall and you can still get a positive return from these funds. I think there is a warning that several of our clients fall into this bucket of being fee sensitive. So it's not suitable for fee sensitive clients, those of you that scrutinize fees. However, the returns that I've shown you are net of those fees. So hedge funds tend to have a big performance fee component. So those fees are elevated when there's been a period of good performance. We've spent a lot of time looking at the fee structures when choosing funds to make available for clients. We've also got those funds proven on the Grade platform, so we can now blend them into client portfolios. And last year in this investment conference, we spoke about Regulation 28. One of the outcomes of that process, that review process, was that retail clients can now invest up to 2.5% into a hedge fund with a total allocation of 10% in their retirement annuities or preservation funds. So it just allows investors to add something different into their portfolio that reduces the overall riskiness of the portfolio, but not necessarily compromising on the return potential. Okay, so that's me. As I mentioned, we're going from strength to strength. We're getting good support from you as our clients. Those initial COVID lessons are behind us, the initial effects are behind us. But over time, as the crisis evolves, so do the challenges that our clients face. We're spending a lot of time trying to understand those. Non-traditional portfolio options are increasing, and it presents an opportunity to build a more robust portfolio for clients. So with that, I'm not going to take any questions at this stage from my side. I'll keep that for the end. I'm acutely aware of time. I'm going to ask our first speaker, who is Johann Els, to come on. Johann is Chief Economist at Old Mutual. Kagisha and I worked at Old Mutual many years ago in the early 2000s, late 1990s, and Johann was there. A bit more hair back then, a bit less grey facial hairs, but yeah, we think it's all the wisdom, Johann, not nothing else. So Johann's going to look at the economic environment and landscape and help us make sense of it. And I don't know, Johann, if there's been an interest rate announcement, perhaps you could.
Yes, there has indeed been, yeah.
Okay, so let me hand over to you, and look forward to your presentation.
Thanks very much. Yeah, that was some years ago, and I'm still at Old Mutual, so yeah, part of the furniture by now. I hope everybody can see these slides.
We can.
Okay. Craig, as always, I don't mind if there's questions or interjections. If you're happy to keep an eye on the chat box, you're welcome to interject with questions or disagreements at any point. Okay, so I honestly believe that it's time to move on from talk about economic stagnation, even from COVID in terms of the economic impact, to looking forward and more sustainable and better economic growth and less fiscal risk. I think there's a lot that has happened, a lot of negatives, but there's also been a trend towards the more positive. So we're looking towards the medium to longer term in terms of the investment horizon, where and how we invest. And I think it's important to not ignore the possibility of better outcomes for South Africa over the medium term. So there's a lot of news and stuff that has happened. The global environment is still supportive. Inflation is a potential issue that investors, markets are worried about. The Fed has started with its policy normalization process, and there's a few potentially significant risks around the higher oil price, the supply chain issues, etc. I view those risks as more of risks for the economic impact than really for inflation. While it might have a short-term inflationary impact, driving up short-term prices, short-term inflation, that also creates a very high base that inflation numbers will be calculated off as we move into next year. I still don't think there's hyperinflation coming. The factors that have forced inflation lower over the last several years, like globalization, technological advances, etc., are still very much with us, and increased competition as well. So I think price rises, cost increases is likely to be more of a risk for consumer and business spending. So likely a potential negative impact on economies globally, in the US specifically. And there the Fed has always been very aware of the risks from the global side that might impact on the USA. So I think the Fed is going to watch this very closely to see if there's any negative economic impact. And that could lead to them easing up on the tapering of QE, might delay the first interest rate increase in the US. So more worried about the economic impact than inflation impact. In South Africa, we've seen sharply reduced fiscal risk from last year to now, thanks to strong short-term growth rebound. But I also think that we should need to look at the medium-term better economic growth coming. Inflation still around 4.5%, despite the recent uplift to 5%, and it's likely to stay at 5% for a month or two before slipping back towards 4.5%. And despite that, and the fact that inflation expectations is anchored around 4.5% or slightly below, and that there's no demand pull inflation in the economy, rates are to go up. My base case was for the first hike in the first quarter of next year. The Reserve Bank announced a few minutes ago that rates is going up on the 19th of November by 25 basis points. So going for an earlier start than what I anticipated. But I think that's a secondary point to the primary idea that rates are going to go up very slowly. Even if there is 9 interest rate hikes between now and the end of 2023, in other words, 25 basis points per quarter, then we'll still end of 2023 with rates below what they were at the start of the COVID crisis in March 2020. So a slow upcycle. It's probably good that they're starting early, then they don't need to be too aggressive. But better growth, better fundamentals over the next few years likely lead to a more stable rand as well. Don't make a mistake, the rand will still weaken. 5 years from now, 10 years from now, the rand will still be weaker than what it is now. Our inflation is still higher than that of the US in the assumptions going forward. So the rand will still continue to depreciate, and despite interim volatile potential cycles, a more stable currency over the medium term. So the global economy, we've seen severe impacts, sharp V-shaped cycle recovery. As we look at these PMIs, Purchasing Managers Indices for the services and manufacturing sectors, the combined one on the left. And you might recall that 50 is neutral, so below 50 is recession or depression, and above 50 is expansion. But you can clearly see this cycle, strong growth, and then the heat of the third or fourth waves of especially Delta variant infection cycles that impacted, as you can see on the right-hand side, mostly on the services industries. And as that waned, some recovery. Nevertheless, still in strong expansionary territory, manufacturing, services, and the total. The global economy looks okay, and there's lots of support for South Africa from that. Perhaps not a commodity super cycle, but commodity prices, especially those ones that South Africa exports, coming off a little bit, but there's enough support even in China for those commodity prices to remain relatively high compared to where they've been in 2018. Graph shows a couple of indicators in terms of the US labor market total, non-farm payrolls, the monthly change on the left. Again, severe cycles during the COVID lockdown, the recovery, and then recently impacted by renewed waves of infection. You can see, especially in the leisure and hospitality industries, and the scale says 500,000. That's 500,000 new jobs per month being added. So while we were running just around that, and then the impact from the Delta variant, much lower increases, so much so that in the total, again on the left, it's been lower than what we have seen. Really what these graphs show, the 3-month and 6-month moving average of that monthly change, the level of employment versus the unemployment rate, all of these suggest that the labor market recovery has come a long way, but it's not completed yet. The Fed judges this as having come far enough that they could have started with that tapering as it was announced earlier in this month. The tapering will be a slow, measured process, and they've only announced the tapering for November and December in terms of the monthly amounts that they will cut back on QE. For now, because they're going to watch this space, they want to see further recovery in the labor market, and they want to watch inflation. There's CPI inflation, both headline and core. If you look at the long history graph on the left, nowhere near where it's been in the 70s, but still a significant jump over a very short period of time. And of course, there are lots of risks around this if it gets entrenched into second and third round price increases, which is possible. But then again, there's lots of competition still out there, technological advances, as I said, and we've seen some of this rolling over in terms of the monthly increases. So on a 3-month annualized rate of change basis, we've seen some rollover. So it hasn't been one path upwards in terms of the month-on-month increases. Although on the right-hand side, the latest number actually was a shocker, a surprise to the markets in terms of what has been happening. The bulk of the latest increase was because of food prices in the US and rentals, both actual rentals and owner's equivalent rent. So the same type of factors we've had that has been very low in South Africa. But looking at the specific COVID lockdown related type price increases, whether that's airline fares or hotel fares, lodging away from home as they call it here, new cars, used cars, etc. The year-on-year impact on the left, very clear how the lockdown, people staying away from airlines, people staying away from hotels, led to much lower inflation in those components, and then gradually higher inflation as those things normalized. Cars impacted by chip shortages, etc. And looking at the level of those severe swings that we have seen recently, some upticks, I think this will continue to stabilize, and bulk of the cost pressures we're going to see due to supply chain issues and lately the oil price. Oil, another question that we can perhaps address later on, but in my mind, high prices create low prices. We've seen that so many times in the past. Just a couple of pointers on that inflation, where the Fed still thinks that inflation is a temporary impact due to these bottlenecks and shortages, etc. I totally agree. I also think this is a temporary impact and not a lasting second, third, fourth round price increases that's going to come from that. There's lots of discussion within the Federal Open Market Committee, the committee within the Fed that sets the policy. I think there's some disagreements there, given the changes that we've seen recently in some of the wording. I think there's a lot of uncertainty in terms of the economic cycle. The risks, as I said at the start, from supply chain cost increases, oil price cost increases, impact potentially negatively on consumer and business spending, that I think the Fed will not be very aggressive in terms of interest rate increases. I still think that the bar for the first rate hikes are pretty high. The first rate hike will still be only in 2023. Might not be towards the end of 2023 as we thought maybe 6 months ago, maybe towards the beginning of 2023. I still think that tapering will finish and the Fed will allow for some time after that before they decide on the rate hikes to come through. To be clear, the Fed has for a long time now, for the last 14 months, said they want inflation to be above 2% for as long as inflation has been below 2%. Remember that after the global financial crisis, inflation basically below 2%. And the Fed wants a measured inflation approach. So their target is 2%, though they want inflation above 2%. They also want a much stronger labor market. So now is the time that they should prove that they want that and be patient with these price increases, inflation risks. Of course, those risks are going to lead to some volatility in the markets. Just briefly on the interest rates in emerging markets, lots of rate hikes in emerging economies coming through because of inflation pressures, which South Africa hasn't had, and that's why we haven't joined this party before. I think to some extent the earlier rate hike in SA might have been some nervousness within the Reserve Bank that we've been delaying this while the rest of the emerging world have been hiking. I want to add an aside here. About a month ago, the Turkish president fired some Turkish central bank MPC members, a deputy governor, etc., to engineer that 200 basis point rate cut that we saw on the 21st of October. Despite the fact that Turkish inflation is around 20%, and not even in the recent past under President Zuma did we have any inkling that the president would fire members of the MPC in South Africa to engineer something like this. Our fundamentals are so much stronger than that. So we stand out amongst emerging markets in terms of some of these issues. Some of you might recall that in the 70s, the National Party government did exactly that, forced the Reserve Bank to cut rates significantly before a by-election in Johannesburg. That's not happening in the new South Africa. Also, the rand has been much more stable than some of the other basket case emerging market currencies like the Turkish lira and the Brazilian real. This is a graph that shows emerging market currencies versus the US dollar indexed to the same starting point. As they move up, that's weakening. The blue line shows a much more stable currency, the rand. Yes, we've had the volatility, less volatilities than some of the others, around these market perceptions. Every time we hear news from the USA around their labor data or inflation data or perceptions around the Fed moves, we've had some of the impact coming through. So the global economy, broadly supportive still for the SA economy, nothing too much out there. South Africa stands out amongst some of the worst emerging economies in terms of fundamentals, in terms of management of the economy. In South Africa, the short-term picture, very much the same as in the global side, sharp V-shaped cycle, significant downside. Last year, minus 6.4%, last year, plus 5.6% growth this year. For some time, people have been arguing that it's impossible to get above 5%, but slowly, gradually, the economy recovered. Lots of export support, slower inventory depletion, even consumer spending helping, and some of the private sector fixed investment coming through. Even if there's no growth whatsoever in the second half of the economy, then what we have already will give us 5.4. As I said, there'll be some growth in the second half. The lockdowns weren't as severe. Yes, the July unrest had some impact, and we'll come back to that. But strong growth this year, and gradually, even the Reserve Bank's forecast and brokers have joined me in expecting above 5% economic growth for this year. Short-term numbers, volatile, sharp downshift in July, some recovery in the numbers in August and September, but still the July unrest impact quite severe. So much so that the third quarter GDP number, when it comes out in the first week of December, likely to be slightly negative. But lots of these will continue to recover. Manufacturing production, for instance, the PMIs are still healthy. Further recovery in mining production. Retail sales already strong, and then Black Friday or Black November plus seasonal sales are coming up. So fourth quarter GDP number back into positive territory, and all in line with my 5.6% growth forecast for this year. Inflation very much under control. Yes, some base effects coming into play. So after that downshift in headline inflation last year, normalizing this year, as I said, around 5% for a few months and then slipping back towards mostly around 4.5% over the next 18 months or so. Goods inflation, of course, impacted by the petrol price increase. That's a big portion of the volatility in goods, but services generally very low inflation numbers, and their rentals have been helping. Rentals and owners equivalent rent with a weight of 17% in the CPI basket, helping quite significant. And food inflation seems to be on the verge of drifting lower. The pipeline prices in terms of grain and meat have eased quite a bit recently. So from the farm to the factory, lower inflation seen in grain, lower inflation seen in meat, and that is now starting to come through in the consumer price inflation numbers as well for grain and meat. And that's some of the biggest components within the food inflation basket, are helping food inflation to ease off as well. And consumer goods inflation numbers have been generally very well contained, rolling over really, and on a year-on-year basis much lower than what we've had in previous cycles. There's no demand pull inflation, and some of these extra cost increases that we see coming through, consumer spends more on petrol or electricity or whatever the impact might have been, and then have less disposable money available to spend on other areas, and that's where you see some deflationary impact coming through in other components. So I'm very happy that inflation is very much under control. And yes, as I announced at the beginning, the Reserve Bank did hike interest rates by 25 basis points. I thought it was opportune for them to wait till the first quarter of next year, but still it was a close call. This graph shows in the bars the number of MPC members. You can see they've changed over time. Back in 2015, there were 6 members. In 2018, there were 7 members, back to 6 members, 5 members currently. And the color of the bar shows the number of votes within that MPC meeting. So gray bars on hold, keeping rates unchanged, red bars to hike is the vote, and green bars to cut. Now, I thought it was unlikely to move from a unanimous hold vote to a majority hike vote. It wasn't impossible because we've seen something similar in September to November 2015. At the September 2015 meeting, all the members of the MPC voted to keep rates unchanged. At the next meeting, the majority vote was to hike. Same happened now. 3 of the 5 members voted to hike rates at today's meeting. Nevertheless, still, slow upcycle, so much so that by the end of 2023, we'll still be below where we were at the beginning of March 2020. And that's a slow upcycle from historically low rates. So I don't think that'll be too detrimental to economic growth. So let's move on to the medium-term growth picture, and really where my title slide has been coming from. It's time to move on from stagnation talk to looking forward to a better economic environment coming through. So from that down cycle in economic growth towards a little bit of an up cycle. Ideally, we should exclude the volatile growth that we had in 2020 and the recovery in 2021. So next year's growth will be lower than this year. So this year's growth is just a rebound from last year. Over the 5 years to 2019, we only had 1% growth on an annual average basis. Now, 1% is virtually nothing. So we're almost at no growth in the 5 years to 2019. My forecast, based on the factors that I'll show you over the next few slides, is that growth can head now to 2.5% on an annual average basis. Now, 2.5% admittedly is still way below the 4 to 5% we ideally need to make serious inroads into unemployment, into poverty, seriously reduce the fiscal risk. But 2.5% is more than double the one we had. So I'm happy to take 2.5. It will start impacting on confidence. It will start impacting on financial markets. It will start impacting on businesses' willingness to invest again in this economy. It will start impacting on foreign investors and on ratings agencies. So 2.5%, far better than 1. And gradually that circular impact in the economy will start working its way through. And that 2.5% should become a little bit more sustainable. And maybe we can, through more policy reform, drive it a little bit higher still. Now, there's a lot of things that have been happening. And no, I'm not saying all of these are 100% correct and they absolutely where they need to be. What I'm trying to say with this slide is that from lots of negatives over that 5-year period when annual average growth was just 1%, from lots of negatives, we've come with those negatives reducing in intensity. In other words, some of those headwinds dying down. And gradually we're moving into a position where some of those headwinds dying down totally, turning into tailwinds, pushing us forward. And those tailwinds should increase in intensity over the next few years. So from bad politics and policy to improving politics and policy making, from a down cycle in commodity prices to much better commodity prices, from rising interest rates to much lower interest rates over a long period of time. The upcycle is going to be slow, from droughts to record crops. And this is the one where everybody sits up and say, hang on, he's talking nonsense. From load shedding to massive energy investment. So yes, we have load shedding at the moment. Yes, it has increased significantly, seemingly over the last few months. But massive private sector involvement in that market. The 100 megawatt self-generation, the extra investments coming from the private sector in that area. A year from now, 2 years from now, the risk of load shedding will be significantly reduced. Remember, we're not talking overnight. We're not talking in all of this from today to tomorrow. We're talking this trend from the worst behind us towards an improving environment. And when I say 2.5% annual average growth over the medium term, it doesn't mean that every year will be 2.5%. 1 year might be 1 year might be 3%, 4% even. On an annual average basis, we're moving into a more positive trend. And even COVID, I think the worst economic impacts of COVID is behind us. There'll be a fourth wave. There might be a fifth and sixth wave. They'll be far reduced in terms of intensity and thus far reduced in terms of the need for hard lockdowns. So we are moving forward. The bulk of the negatives moving into the rear view mirror and some of the positives coming through. Lots of the policy interventions that we've seen over the last few years, especially under the Ramaphosa government, the fiscal consolidation, private participation, making some headway with corruption fight. They are making some headway. It's slow, it's drawn out, but it's happening. The infrastructure focus, the focus on the cost of doing business, reducing red tape. Lots of these things are starting to have an impact, not only in terms of the actual impact on the economy, but in terms of the actual impact on confidence, which will drive future investments, etc. So improving trends. Now, of course, we need to do a whole lot more if we want to get to that 4%, 5% economic growth on a sustained basis. And the two big ones that I want to lift out is full-scale privatization of state-owned enterprises. And that's probably unlikely to be full-scale. And the P word, privatization, is probably still a swear word. And most of the ANC or its tripartite alliance partners. But maybe to some extent, privatization by stealth is happening. All this private sector involvement in energy generation that used to be only for Eskom. The private sector involvement in other SOEs, Transnet, the ports, etc. That might expand. So some of that is happening. And that's why I said maybe that 2.5% can become more sustainable. Of course, we also need substantial labor market deregulation. Again, that's probably unlikely as well. But on the other hand, COSATU is not as strong as it used to be. In fact, I might argue that it's weakest point currently. So the difficulty, of course, there is the political will to do these things, the need to do these things. There's other issues on that slide, which I'll skip for now. I want to focus on this briefly, that there's lots of positives in the SA system, existing strengths. And there's a lot there. I'm not going to go through them one by one. The strong institutions, the independent central bank, for instance, that's hugely important. The fiercely independent judiciary, the rule of law that was established as being supreme when the Constitutional Court sent the previous president to jail. And I can hear you thinking, yes, but he's out of jail. That doesn't matter. The principle was established by the decision. The fact that he's now out of jail doesn't really matter. I mentioned earlier Not even a President Zuma dared firing a Reserve Bank governor or APC member to try and engineer rate cuts or something like that. So conservative policy, great sophisticated financial markets, all of these factors will help add on to those policy measures, add on to that slide that I showed in terms of improving politics, improving policy making. Incidentally, I'll come back to policy when we talk about the MTBPS soon. Gradually, all of this will lead to increased confidence, and confidence is a key ingredient in getting that growth on a more sustained basis upwards. Let's briefly, lastly, talk about the MTBPS before we take some questions. I think it was a hugely positive MTBPS, especially compared to last year, when that was a very dismal statement from the previous finance minister. The very market-friendly statement and the focus on fiscal sustainability, and I've got some quotes on this slide and the next one, from the Minister Godongwana, going out on a limb really and pushing that significantly, saying unflinching commitment to fiscal sustainability. So after the July unrests and the ANC's reduced support in the local government elections, many feared that this might mean a jump to the left in terms of policy making. In other words, spending our way out of the issues. It wasn't to be. I always thought that the July unrest might actually turn out to be an inflection point for better policy reform down the line. In the local government elections came in, I think that added to that. To some extent, we're seeing that the government, the ANC, actually realizing that they can't turn to the left, they actually need to strengthen policy to the other side. So lots of positive messages coming through from the MTBPS. I think the strongest message was that the minister said, we can't spend our way out of these issues. The best way, and the quote at the bottom there, let me reiterate that the permanent solution is to achieve high and sustained levels of economic growth. He went on to say, through structural economic reform. So not only is the statement of intent very positive, but also the fact that he had a list in terms of all this policy reform that they're going to do and do it quickly rather than later. Also, in terms of the worry that there'll be a basic income grant, that more spending coming on the social grant system, whether it's a basic income grant or start of a basic income grant, or whether it's a continued extension of the COVID grant or some kind of an unemployment benefit grant. The minister said clearly, only if we can do it in a deficit neutral way. In other words, if there's some extra tax revenue coming in, taxes higher than expected. Incidentally, there was no tax increases in this, or no planned tax increases. So only if there's extra revenue coming from somewhere, or if they can cut back on expenditure elsewhere. They're not going to continue on this path of short-term increases in expenditure. They're going to keep the lid on spending. So I'm going to skip a couple of slides. Craig, you can send this presentation out to everybody. I want to highlight this one, where last year, the blue line, the government's debt to GDP ratio was shown to only peak at 95% of GDP. Now, Treasury's line is this thick green line, below 80% to GDP. And yes, to some extent, the uplift in nominal GDP has helped. But if we get towards a 2.5% annual growth in GDP, then my black line there could be the outcome. So a reduction in fiscal risk out there, significant reduction in fiscal risk. That will clearly help ratings agencies also to gradually start grappling with this. And I believe that we're probably at the bottom in terms of the ratings. I don't think we're going to see further ratings downgrades. In fact, after the February budget, I think Moody's and Fitch will both still have a negative outlook statement in terms of the outlook, and change that negative to stable. Make no mistake, it's still going to take some time before we get an upgrade in ratings, and longer still before we get back to investment grade. But I think we've stopped the rot. We're now at a point in time where we can start improving. So time to walk away from the negative views of the stagnation in terms of economic growth, better outlook going forward. I can add a lot to that, but let me stop here and take some questions, and I'm sure you've got lots of disagreements as well, so I'm happy to argue.
Great, Johann, thank you for that. Very detailed. Yeah, lots of lines, but that's the world of an economist, lots of graphs. I think just in terms of the interest rate hike this afternoon, we've seen the rand weaken well, it seemed to coincide with the announcement of the 25 bips. That suggests that perhaps the market was expecting a bigger hike, particularly offshore investors. What would you make of why would you think that the rand would weaken despite rates?
Craig, it's always very difficult to decipher what the market is thinking. Maybe the market was thinking no rate hike. So maybe the rand weakened because the market thought the rate hike might weaken economic growth. As another side to that argument. But yeah, you started the introduction by saying how long I've been at Old Mutual, and I've been an economist for longer than that. So my view has always been we look towards the medium to longer term. I try to ignore this noise. Today's move in the currency I would really call noise. And I view my job as to look through the noise and to see the bigger picture. So I think by next week we would have forgotten what the rand did exactly today. But I suspect that, you know, once markets realize this is going to be a slow upcycle in terms of the rate cycle, a slow normalization, we're not going back to the pre-COVID rates, policy rate in South Africa by this time next year. It's going to take 2 years before we're getting close to that. So a slow upcycle, not a big negative in terms of economic growth.
Yeah, there's a question here from Wynand. I'm not too sure if this would be answered by you or by Richard, our next speaker, where he asks, you know, with the inflationary pressure, what would you suggest are the best assets to invest in to hedge against rising inflation?
Yeah, probably not so fair to ask me that, Wynand. I tend to not delve into the portfolio management or those kind of areas of the business. So let me rather leave it there.
That's fine. So we'll put that question to Richard later. Maybe he addresses it in his presentation. The other question I have here from Paula is the Minister of Finance was a bit more conservative with these growth estimates at an average of 1.7%. Is that perhaps you have different timing periods in mind? It's a 3-year view that they generally give.
Yeah, absolutely. So I actually view that as a positive in the sense that his conservative budget making, both in terms of his growth forecast, but also in terms of Treasury's growth assumptions for the big tax components over the next few years. So growth likely to come out better than theirs, tax revenue growth likely to be stronger than theirs. So I view that as a positive that they're conservatively budgeting. I think when I take a broader view of Treasury, of the Reserve Bank, of the credible brokers out there, virtually everybody expects growth over the medium term to be better than what it was in terms of that 1% annual average over the 5 years to 2019. Mine is perhaps towards the top end, but there's quite a few people that says above 2%. I say 2.5%. I know there's 1 or 2 that still says around 1.5. Even that's slightly better than the 1. We're moving in that direction. These things tend to build on each other. Suddenly, when everybody realizes things are looking better, this massive energy investment coming could potentially be the growth driver over the next few years for South Africa, because energy investment, other private sector investment, private sector involvement in infrastructure, that could potentially drive it.
I think just a final question and no questions from the clients. Biden's meant to announce a new Fed chair, I think, in the next few days. Do you think that would have any impact on the outlook for US sort of interest rate trajectory? Or is that committee firmly entrenched and, kind of consensus?
Yeah, there's two views there. The chairman is very important. Like in any business or in any area of politics, people tend to drift towards the leader and the leader's position. But I think that in general, when we've seen changes at the top, at the Fed, they tend to take a while before they enforce their views if those views are different than the previous leader, especially in order to keep that stability. So I don't think there's going to be huge changes. We saw that with Jerome Powell as well when Trump appointed him. Trump thought he was a shoe-in to do what Trump wanted, and he didn't. So the same with a potential new one. I don't think it's going to have a big impact at all.
Great. Johann, from our side, thank you very much. You presented at our conference before, and we always look forward to hearing you. So on behalf of everybody at GM Investments, a big thank you from our side. The last time I was able to put a bottle of wine in your hand immediately, but in a COVID environment, we have to make alternative plans. But yeah,
no worries.
Thank you
very much for the opportunity. Have a great conference. Bye-bye.
You too. Take care. Cheers. At this point, I'm going to ask Richard Simpson. Richard is the co-founder of Obsidian Capital. I met Richard in the late 1990s. Quite familiar with a lot of his achievements when he worked at RMB, managing money there. So also quite excited to when I discovered that he was together with his business partner Royce had started Obsidian Capital. The name caught my attention. Was my then 4-year-old son, 5-year-old son, Obsidian was his favorite color, which was quite unusual for a kid. But we discovered that was a Minecraft thing. So Richard, your mandate this afternoon is to help us make sense of that economic picture that was painted, and how do we invest money in that kind of environment? You as an asset allocator having to make those decisions with people's money, how are you seeing the world? We look forward to your presentation. Welcome.
Thanks very much, Craig. Appreciate the opportunity to talk to your clients. I really enjoyed Johan's presentation. I think a lot we would agree on. And the advantage of going after an economist is rather than kind of rehashing, which a lot of stuff I'm probably going to overlap, I'm going to look and try and pick on areas where we perhaps slightly different in terms of our view than Johann. So we'll do that. We also as a brief from Craig, going to give an update on Obsidian as a business very quickly. We'll talk about the hedge fund returns and the mandate of the hedge fund, and then talk about financial markets. So I'm going to be very quick through the first bit because I'm pretty sure you're going to want to talk about markets. So just Craig has introduced me. Just to introduce Royce, my partner in the business. We've been together since '94. We started at RMB Asset Management. We've been in the industry for 28 years. I was a chief strategist at RMB. Royce was head of financial research. We have the unique partnership, if you want, of managing money together since the mid-90s, running product together. So it's been a great journey. We come at problems and markets with a very different skill set, which I think is useful, and certainly with the challenge of markets, particularly in an emerging market context. It's always nice to have a sounding board, and therefore we think a partnership in managing money works very well, and certainly Royce and I's partnership has been a success since the mid-90s. In terms of our experience, as well as the rest of the team, we've got over 100 years of experience as a small investment team in Obsidian. We've been through 5 interest rate cycles, 6 commodity cycles, 5 all-share real earning cycles, 4 real effective exchange rate movements in the rand, both in terms of strengthening and weakening, and unfortunately also 4 stock market crashes. So I think, this slide talks to the fact that A, Obsidian Capital's got a lot of experience, and B, we've certainly navigated a lot of challenges and cycles through our investment career. Just really in terms of the culture of Obsidian Capital, we're 100% owned by the founders and investment team. So we don't have a strategic shareholder putting pressure on us in any way, which I think it gives comfort to investors, and therefore we are accountable to every decision we make within the business in terms of making investment decisions. We also, very importantly, put our own money, our own savings into the product we manage, and a significant amount of Royce and my savings sit in the multi-asset hedge fund, to which I'll be focusing on today. And I think that focuses our mind as well in terms of managing money correctly and optimally. We're totally benchmark agnostic, so when we construct portfolios, we have no bearing on what the size of a share is in the index. That's number one. So we populate a portfolio based off investment merit rather than portfolio weighting merit. Saying all that, we're not a bet the farm approach. We tend to move incrementally, through the investment cycle, and hopefully add value incrementally. There's nothing particularly complex within our hedge funds. There's no elaborate exotic futures or options or derivatives. It's a very simple long-short strategy by and large. It's tactical asset allocation. We completely believe in that. We believe that asset allocation is vitally important in terms of adding an absolute return through time. And at all times, they're trying to overweight the asset classes that we deem to be the most attractive. We're not afraid of contrarian thinking, and I think there have been times where we've been aggressively underweight offshore exposure and vice versa. I think as much as a lot of product we run is Reg 28 compliant, there are times where we will significantly reduce our offshore exposure if we deem the rand to be significantly undervalued. And then finally, our catchphrase, if you want, for Obsidian Capital is marry valuation with a cycle. And what we mean by that is it's one thing to identify value opportunities, but it's another thing to finesse the timing of getting into an asset class that's cheap. And hence we do have a kind of we do spend a lot of time looking at macro drivers in order to try and finesse the timing of investment decisions we make. So getting into the multi-strategy fund, Craig has been a supporter of this fund for some time, and we appreciate that. Royce and I launched this back in over 14 years ago now, 13-year track record. And I think when we were launching, it was quite unique in the sense that it was a multi-asset portfolio rather than an equity long short. And Royce and I looked at each other and we said, when we look back over this fund, what objective do we want to achieve? Bearing in mind, we also have our own money in this portfolio. And we set an internal benchmark, which was to compete with balanced funds in strong markets and compete with hedge funds in weak markets. And I think, that's an internal benchmark. It's not the official benchmark of this portfolio. And I think, that's a very difficult objective to try and strive for. And hopefully looking back over the 13, 14 years, I think we can demonstrate that we've been quite successful in achieving that ambition. And we believe it is a very challenging ambition to try and strive for. The fund is diversified across all major asset classes. Think of this fund very simply as a global flexible fund. In other words, it's got no Reg 28 limitations. We can be maximize offshore, hopefully at the appropriate times, or vice versa, bring everything back home. But it's a flexible fund with an additional tool of shorting, hence it being a hedge fund. That's perhaps the best way to think of this fund, a worldwide flexible fund with an additional tool of being able to short asset classes. Level of gearing can't go above 2 times, so relatively low level of gearing. As I said earlier, the investment team has got significant investment in the fund, keeping us focused. Management fees are high. It is negotiable. This is obviously our highest class fee of 1.5%, but certainly Craig, has, because of bulking and negotiation, we can reduce that fee. So it's an annual fee and a 20% over CPI plus 3. It's a high watermark, very important high watermark principle, which means at the end of each year, we lock in the return. And if we more importantly, if we underperform the benchmark, we have to make good on what we missed out the year before we can participate in management performance fees. So the end result is it's CPI plus 3, but because of the watermark principle, the actual annualized performance fee benchmark is approximately 11% per annum, which we believe is a very honest benchmark in order to try and outperform before you participate in performance fees. Just in terms of the details, it's daily liquidity, daily pricing. So it's in effect is a unit trust. We also obviously offer segregated funds. It's on the Momentum, Allan Gray, Glacier, Prime, Hollard, Insignia platforms. So quite well represented now in terms of hedge fund exposure. And that's really, in essence, is the fund. We'll skip over the long short, but just for consistency, we do have an equity-centric long short hedge fund as well, with also a long-term track record. Just turning to the performance quickly. Very importantly, the benchmark is CPI plus 3, which is, if you look at the relative starting at 100 back when we launched the fund in September 2007, we've significantly outperformed that CPI plus 3 over time. But more importantly, we've added value against competing long-only balance funds as well, some 50 to 60% better than competing balance funds. And if you look at the long-term returns over the 10-year period, 11.5% versus the average benchmark of a balance fund of 8.8, or since inception, 11.3 versus a balance fund of 7.7. If you compound that over time, as you can see from the top graph, it's a significant value add relative to the traditional long-only multi-asset product of the Reg 28 long-only funds, which is why we say we're quite proud of the fact that we've been able to be competitive to that internal benchmark that we set. Perhaps another way to look at this fund is to put this return since inception versus a whole range of very honorable and competing asset classes. So what we've got in the bold green line is the Obsidian multi-asset hedge fund since inception in 2007. And then we've got a range of competing assets, including the Allbe, the All Share, excuse me, the cash, worldwide flexible, balance funds, equities, and then MSCI World. And again, very comforting to see that we've been better than all competing asset classes other than 100% MSCI World, which is slightly unfair because that's an index rather than a fund. So there should be some fees that come off that. Our returns here are all net of fees, very importantly. So I think it's been a very competitive fund, and certainly the team is very proud of the returns we've generated. Final slide in terms of performance. If you look at the Obsidian multi-asset hedge fund, a couple of observations. We launched in the last quarter of 2007. We've never had a negative year despite some very challenging markets, not least 2008 when the market fell 30-odd% and the average balance fund was down around about 10%. The compound annual return of 11.2 is very competitive against all competing asset classes. So just comparing 2020 to 2021 year to date, clearly a significantly more buoyant market across the board. What we've done in these two panels, the first panel are annual returns all in Rand and local currency returns for the year 2020. And then on the right-hand panel, you can see the same asset classes, but obviously across the board, meaningfully better returns to be had than in 2021. And I guess the obvious question is some of the laggards towards the bottom, whether those can participate. One of them, by example, would be Rand Gold, which is down 2% versus up 31% the year before. So clearly opportunities across the major asset classes to look for some recycling at all times as we go forward. Listed SA property, a very good year, up 21 versus down 44 the year before. By way of example, SA Banks leading the way this year, up 22 versus down 18 in the year before. So with that in mind, And really reflecting a little bit on 2021 in terms of how buoyant the year has been. It's in essence a classic wall of worry year, where there's been an enormous amount to be anxious about, not least the sustainability of the very powerful economic expansion that we're currently witnessing, particularly led by the US economy. Big debate as to whether there's inflation or whether this is just a cyclical inflationary period in a multi-year disinflationary environment. We can deal with a little bit of that as we go through. What's the 10-year bond telling us? How severe is Delta? And clearly these are things that have played out through the course of the year. Will the commodity cycle abort? This growing energy crisis, which is particularly onerous for regions of the world like Europe. Is the dollar weakening or strengthening? Particularly weak commodity currency and global cyclical currencies in the form of the Aussie dollar and the Korean won, and the peculiarity of the message they are perhaps giving us. And then again, this whole year has been one of, is the rand going to offset commodity strength or enhance it? And then finally, the severity of COVID third, and now we're entering what looks like entering our fourth wave within South Africa, and how severe that will be. And then, of course, just to make a challenging year worse, the dramatic domestic unrest that we saw playing out in July of this year. So we'll try and deal with some of these anxieties as we go through the presentation. The first chart here is a very important chart which we hold close to our hearts. This is our Obsidian Global Economic Indicator. The higher the red line goes, the more reflective of how buoyant the global economy is. You can see really in the COVID crisis of 2020, levels last reached in recessionary periods of the global financial crisis and the global recession of 2001. So severely compressed indicator nearly 2 years ago now versus a exact opposite, where we have a deeply expanded global economic indicator. And of course, the big question is where to from here. Why we treat this so important, so why we believe it's so relevant, is if we overlay world equities relative to bonds as the major asset allocation decision multi-asset fund managers have to make, you can clearly see a very sharp correlation. Whenever the red line trends higher and remains buoyant, equities tend to outperform bonds, and vice versa. When you have a contraction in this indicator, bonds begin to outperform relative to equities. But just to make it's one thing calling the cycle, but what's been really unusual has been this concept of financial repression that asset allocators have had to deal with now for the better part of a decade. And really to indicate that, in the bottom panel, you can see we've got, reflecting European equities for a moment here, and European interest rates. We've got German 10-year bonds and German 2-year bonds in orange and green. And you can see that they've been deeply negative in nominal terms in recent years, versus the DAX dividend yield reflective of European equities at around about 2.6 currently. So at the end of the day, you have to be absolutely convinced that global growth is slowing dramatically and that earnings have peaked in order for you to move outside of a 2.6% yielding equity environment to asset classes where you literally have to chip in. I mean, you really have to be convinced to go to cash in Europe and give away 70 basis points every year just for the luxury of owning cash, or 40 basis points for owning, 40 to minus 20 basis points for owning the long end of the curve. The top panel just illustrates the relevance of growth, and we've got industrial production in gold, and we've got white being dividends per share in the European equity market. And you can clearly see with growth accelerating, and we believe it should continue to accelerate into next year, dividends should remain relatively supportive. And hence, almost irrespective of our view of the cycle, we believe there are companies in areas where there's financial repression in the world, like Europe, to eke out a return in equities rather than giving up on equities, simply because there's no alternative. I mean, if you compare that to 2007, for example, where earnings were maturing, but at the same time you could get meaningfully higher yield from bonds and cash than you could from dividend yields back then. That situation just isn't available at this point in time. Coming back to our economic indicator, you can see in red is the indicator, and blue is our Obsidian Composite Commodity Index. It's been a particularly strong year, as you guys know, for commodities since the end of the COVID lockdowns in March of 2020. But if we look at other multiple confirmations, the measures of asset allocation, there's a range of them listed on the right-hand side here. World equities bonds, clearly still supportive of equities. Global bond yields, on the other hand, have been relatively mixed. We're not really seeing a kick in bond yields that we would have anticipated. Global commodities have been strong, but cyclical currencies, including the rand, in red, the Korean won, the Aussie dollar, have all been particularly weak year to date, and that's particularly unusual in the face of a very strong commodity environment. The copper gold ratio really is correlated quite nicely with our red economic indicators, neutral at the moment. G3 industrial production is still accelerating. S&P 500 ratings are elevated and directionally mirroring the direction of our global economic indicator, and business confidence also very favorable. But Chinese interest rates, as you know, have been falling recently, and freight rates, which have been very, very strong of late, have rolled over in recent weeks, and we will talk to that as we go through. So what's really the world been about in the last year? We believe this incredible retail exuberance that we've seen from the US is a product of helicopter money and COVID. And if you look on the left-hand panel here, we've got US retail sales. This is just value of US retail. And you can see in the two previous up cycles, retail value has grown by around about 4 to 5% per annum. But if we start the same index from a pre-COVID base towards the end of 2019 to date, you can see we've had an incredibly strong step up in consumption in the US. And you can see a 17% per annum versus a 4 to 5% trend over the last 20 or 30 years. And that's an extraordinary level of consumption of goods. And we think that more than anything else has been the reason for these global supply chain disruptions, port congestions, freight, extremely high freight rates that we've seen persisting around the world. If you look on the right-hand scale, you can see that durable goods, as elevated as they are, it's not reflective of the economy as a whole as far as consumption is concerned. You can see services have been left behind and are still to reach the levels of a pre-COVID base. So very, 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 very important to identify that this arguably a lot of the commodity strength that we've seen in the last year to two has been very possibly a function of this excess goods consumption that we've seen being playing out in the world. If you add China to that, you can see China. This is an incredible chart really showing Chinese retail value in dollars versus the US, and you can see from 2006, where they were a fifth of the size of the consumption of the US. Today, they're more or less the same size as in terms of value consumption as that of the US. It's an incredible journey, literally taking a billion people out of abject poverty a couple of decades ago to now one of the largest economies in the world, and particularly important when assessing consumption trends going forward. But what's really happened now? I mean, we've had incredibly strong growth in consumption, and it genuinely has led to some supply chain bottlenecks playing out in the world. Perhaps the best one would be this chart that we've got in front of you here. It's German industrial production in red, which you can see that was accelerating in the earlier stages of coming out of the lockdowns. We've got German's PC and electronic manufacturing, which is fully rebounded from the lockdowns of COVID of 2020. But more importantly, if we look at German's vehicle manufacturing, you can see it's now getting back to levels well below that of the global financial crisis, and in fact not that far off from the severe contraction that we saw during lockdown. And that really talks to this incredible shortage we've had in semiconductors, or chips as they're known. I believe there's some 1,400 chips per car these days in a modern car, so incredibly reliable, important for the production of vehicles. And this really has caused incredible distortions in growth. And you can see Germany, as a major producer of vehicles, has suffered tremendously as a consequence of this. And this has also had a role to play in terms of the recent sell-off that we've seen in things like the palladium price. If you consider 4 million cars lost, we're currently doing 75 million cars of production versus a peak of around 90 million in 2018, 2019. Only 4 million of those will extinguish the 800,000 ounce palladium deficit. So, you know, it's important for our PGM industry, not least growth in quite a lot of major economies, that the semiconductor issue resolves itself, and this gold line hopefully would provide impetus for growth into 2022. Turning to inflation for a moment, and I think this is the most contentious, and I think probably at the moment one of the hardest issues in terms of financial markets to get your handle on at the moment. But what we've got here is we've got a Obsidian US headline inflation model in red, and we've got US headline inflation in blue. And you can see, if you look quite closely at this chart, you can see a very sharp rebound in our headline inflationary model coming out of COVID. But more recently, we're starting to see some stability in terms of this index. And this would suggest to you that as far as headline inflation is concerned, we could be closer to a top than perhaps the market anticipates. And if one looks at the commodity index, which is obviously a very important driver of that inflation model, not least oil, food, commodities across the board, all of these we've tried to include in our Obsidian Composite Commodity Index, along with the global steel price, which you can see in blue has had an extraordinary run since the end of COVID. All right now are starting to look like they're close to basing out. And it's early days, and this might just be a consolidatory period, but it's very possible that we are closer to a top as far as the major commodity prices are concerned. And if that is the case, at least headline inflationary pressures will begin to ease. The reason why we can't be completely conclusive about this is because of the more sticky core CPI drivers that are playing out within the US at the moment. We've seen wage pressure relatively dramatic at the moment as unemployment has been absorbed. But if you look at rentals, and this is important because it's 33% of the basket, and if we lead the house price index within the US by 15 months in the green line, you can see that there's a very real risk that rental inflation, the rental component of core inflation, is going to rebound significantly from here. It's already back to 3.1 from around about 2% in the middle of COVID. And if one looks at this relationship in the past, it suggests that we could still see some core inflationary pressures continuing as we go through. The left-hand side, though, is perhaps more optimistic for inflation, not getting ahead of itself. And if you look at some of the peculiarities of supply chain and these COVID reopening components, you can see red and green, both adding substantially to the core CPI, which if you exclude reopening and chip shortages, etc., you can see that core CPI in the US, at least up until the second quarter, was not particularly problematic. And you know, one can only hope that the reopening and chip shortages will resolve themselves going forward. So it's a long story, but you know, headline inflationary pressures at ease. But if we put the core CPI elements into it, we're probably likely to remain relatively elevated, at least for the next 6 to 12 months. But really, at the end of the day, it's how important the market treats this as far as interest rates are concerned. And if we turn to the next chart, what we've got in blue is the US 10-year bond, currently at around about 1.5, 1.6. We've got 2-year interest rates around 36 basis points at the moment. And then all we've done here is we've inverted US unemployment. And you can see that we're now at a point where unemployment has fallen to levels reached in 2016. And why that's important was that was broadly where the US felt it necessary to start hiking rates in the past. So I think, you know, as far as we're concerned, we think US rates better go up sooner rather than later. if they don't go up in the shorter term rather than the longer term, then we would say that they're probably not going to go up at all. Certainly inflationary pressure along with job data suggests that they can start tapering almost immediately and accelerate their tapering. And right now, as we see the world, we would anticipate rate hikes very possibly happening as early as in the first half of next year. And that, I think, is very different to the rhetoric that you're hearing from the Fed at the moment, which is suggesting the back end of next year at the very earliest. And in fact, some economists are suggesting only in 2023. We think, and we feel quite strongly about this, that if they are going to raise rates, they must get onto it sooner rather than later. And if they do, we believe it should happen over the course of 2022. So how's our own bond market going to handle a rising interest rate environment as far as the US is concerned? Rather concerningly, if you look at our SA 10-year bond in blue and our own SA inflation drivers, you can see that in the past few cycles, the red line being broadly a mean reverting series, you can see that our 10-year bond tend to follow our inflationary pressures both up and down quite closely. But in recent cycles, and draw your attention to 2019 by way of example, where our inflationary pressures eased quite strongly, you can see that our 10-year bond continued to trend higher or at best remain relatively stable. So it seems when one looks at this that the financial markets are less and less willing to respond to lower inflationary pressures. And in fact, we're sharing on all the upside as inflationary cycles come through, but we're not enjoying the downside. And one of those reasons, of course, is the very sad reality that, you know, South Africa has been mismanaged. We're running out of key things like water and power. I mean, this one chart just shows you the amount of time that we spent in load shedding, and you can see 2021, which isn't over yet, is now a new record in terms of the amount of energy shed during load shedding. And you can clearly, the overall conclusion from this is you can see that what started in 07, 08 stabilized for a few years, but unfortunately since 2018 has got increasingly worse, suggesting that we really as a country have simply run out of power or the ability to generate power. And the simple conclusion to that is South Africa cannot grow, as you know, without sustainable energy. And without that, it's clearly going to be very, very difficult for financial markets where in the face of rising debt to GDP, it's going to be very difficult for particularly the long end of our curve to rally into any disinflationary cycles going forward. But for the moment, if one looks at our entire yield curve, going out as far as the R48 all the way down to three-year data, at the moment we would suggest as bond yields and interest rates normalize in the US, we feel you'll be safer in the longer end of the curve. Again, we emphasize we don't envisage any capital appreciation in this environment, but at least you're picking up relatively attractive yields of close to 10%. And all of this while global interest rates normalize at higher levels. Turning to currency markets, it's been an incredibly unusual period, we believe, for the US dollar. Just taking a step back for a moment, looking back to the 90s, you can see periods of both weakening and strengthening dollar cycles. You can see the last period where we had a very weak dollar cycle was between 2002 and 2011. And why that was relevant was that coincided, not coincidentally in our opinion, with the very powerful super cycle in commodities that played out over that duration. 2011 through to 2015 was an incredibly strong dollar. You can see the red line trending down, illustrating the very strong dollar. And since then, on average, the dollar has been a mildly weakening currency. But again, we emphasize that as much as the line has been slowly trending upwards, suggesting a weaker dollar, it's certainly not been the case through 2021. As you can see, we've had a very sharp rally in the dollar and a particularly unusual period of dollar strength in our opinion. Perhaps the best way to illustrate that would be the next chart, where we've got the Korean won in gold. When the gold line is trending upwards, the Korean won is appreciating against the dollar, and when it's falling, the Korean won is weakening against the dollar. And if you look at 2020 and along with this chart, we've got Korean exports in white, And you can see the very intuitive relationship that you've seen between these two charts going back to 2008, when Korea's exports, and appreciate that this is an economy very geared to global exports as a whole. So when exports trend down like they did in the global financial crisis, it's kind of intuitive for the Korean won to weaken, and vice versa in periods where exports are appreciating. But what is very strange about 2021, and to be honest, we're struggling quite significantly with this, and we'll refer to that when we come to the Rand. But you can see, despite the fact that the Korean exports are hitting all-time highs, reflective of the incredibly strong economic cycle that the global economy is enjoying at the moment, you can see this massive dislocation where the dollar has been very, very strong, despite the reality of very, very strong export countries. Turning to the Rand, you can see a not dissimilar environment in recent months. Firstly, this is our fair value chart. The bold red line running through the middle is what we would deem to be fair value of the Rand, based off inflation differentials. You can see how significantly undervalued the Rand was towards the end of the lockdowns of COVID in the first quarter of 2020. It then spent almost a year and a half appreciating, almost got to fair value a few months ago. And more recently, we've seen significant weakness again in the dollar, taking it back to around about 20% undervalued against the dollar. Very importantly, this is not unique to the Rand. This is more a function of the incredibly strong dollar that we've witnessed of late. Again, just to highlight the dislocation, if you look at the red line, which is again going back to our economic indicator, you can see very elevated periods of growth, reflective of Korean exports, as we showed previously. But despite that, you can see the real effective exchange rate of late being the blue line, and when the blue line trends down, the Rand is weakening in real terms. And you can see that it's just of late been very, very weak and breaking the relationship and the long-term relationship that we've traditionally seen. You can see the difference between the very weak Rand in the first quarter of 2020 as COVID bit and lockdowns happened. You can see how weak the real effective exchange rate was. But of late, you can see, despite elevated growth, a very sharp deterioration in the Rand. But again, we emphasize this is not actually about the Rand as much as the dollar. And if you look at the Rand against some of the other crosses, in the top panel, we've got the Rand against the yen, and appreciate the yen is a very strong currency through time because it's got a very low inflation rate relative to its trading partners. You can see we've mean reverted fully against the yen. We were very undervalued back during COVID of early 2020. We appreciated some 30 to 40%, almost touching some 20% overvalued a few months ago. And we've seen moderate, albeit very moderate, weakness against the yen since then. And then if you compare apples for apples, if you compare the Rand to the Australian dollar as another commodity currency, you can in fact see that from COVID, where we were moderately undervalued, you can see we've moved to some 20% overvalued against the Aussie dollar. And again, indicating that the Rand, whilst it's been weak against the dollar, has actually been relatively strong against a lot of the crosses. And again, if you look at the Rand against some emerging market currencies, it's an even stronger point to be made, where emerging markets have been considerably weaker than the Rand of late. But looking through all of the noise, if you like, if we right to be approaching the top of the current commodity cycle as per the red Obsidian Composite Commodity Index, which looks like it's starting to base out at a peak. And if you overlay that with the Aussie against the US dollar, you can see, despite the fact that the Aussie dollar has been weak all year, and again, consistent with our message that it's been a very odd year where commodity currencies as a whole have not participated in the incredibly strong commodity cycle that we've enjoyed. Despite that, if commodity prices fall going forward, it's going to be unlikely to see any strength come back into commodity currencies. So turning to our positioning at the moment in our multi-asset hedge fund, currently got around about just under 50% net equity in the portfolio, so still relatively high in equity. Our largest component has been interest rate sensitives. We're starting to pull that back. But if we wind the clock back to the end of COVID in the first quarter after the significant sell-off, we had a barbell strategy where we had a significant amount of resource exposure coupled with interest rate sensitives and very little in rand hedges. As the year has progressed, we've pared back our commodity exposure, maintained a lot of our interest rate sensitives, but again, journeyed out of a lot of the retailers in favor of some of the reopening trades like healthcare and banks and insurance companies. Rand hedges, we've remained relatively underweight domestically, but that's mainly as a function of some of the dual listeds which we don't find attractive, most especially Anheuser and BTI. So what we have done is increased our offshore exposure in anticipation of the currency being weaker against the crosses. So we emphasize we don't have a lot of dollar exposure right now, but we do, and we have been increasing our offshore exposure to non-dollar currencies. So our offshore assets are currently up to just under 35%, and that's a mix between EM and DM. That EM equity is at least half of that is Chinese equities stocks, which we've been buying of late, particularly technology stocks, the likes of JD.com, NetEase, Tencent Direct, as a consequence of their fairly aggressive sell-off in the first part of 2021. Just in terms of bond exposure, still relatively underweight. Saying that, we short the very long end, very short end of the curve, being the R2023s. And then, as I said earlier, looking for relative defensive exposure in the longer end of the curve in the R2030s, and then augmenting that with some inflation linkers. And that really speaks of the bulk of our domestic exposure, some 4% in direct commodity exposure. If we look at how we've transitioned through the course of the last several months, you can see our cyclical exposure, which was as much as 19% in April, has been brought back to 12. The interest rate sensitive exposure, as I said earlier, has been pared back to a degree, but not to the same level as cyclical exposure. And then we've significantly increased our offshore from 25 up to around about 35%. And the remainder remains relatively consistent, other than slightly higher bond exposure than what we had in April. So just our top 15 equity longs: Transaction Capital, Lewis, Standard Bank. Talking to our large bank exposure, still Pepkor, we've been reducing, been a very good investment for us. Netcare, our hope is that the hospital groups, which suffered tremendously on the back of COVID, will have a better experience in the ensuing waves, and that hopefully will lead to a normalization of profitability at much higher levels, pre-COVID levels. Investec PLC, we think, is a very undervalued bank, augmenting some of the local bank exposure. Itaú is a Brazilian exposure. We would hope the currency, which has not participated since COVID, would show a degree of stability. So far it hasn't, but we wait relatively patiently in that exposure. Process, along with our offshore Tencent exposure, really just picking up our Tencent exposure more recently. We're relatively underweight in the first half of the year. And then Signia Japan is really just a function of the fact that, as we illustrated earlier, we think the rand is relatively overvalued against some of the crosses. So to conclude, synchronized growth has recovered with immense stimulus. COVID evolved from being a growth depressant in the earlier days to a growth stimulant. The fact that there's been these ensuing waves has caused central bankers to be reluctant, we believe, to close down stimulus. And at the end of the day, this has led to an incredible consumption cycle, which has flowed through into some of the consequences, as we highlighted. The pace of the rebound, we think, will moderate from elevated levels, particularly in the US as we phase into next year. The current cycle strength is absolutely key in terms of sustainability going forward, as far as asset allocation and preferring equities over bonds. We were saying that we would like to see competing asset classes, fixed income as a whole, to be at higher yields before we give up on equities as the preferred asset class. Inflationary pressures need to be monitored. We acknowledge that there is some hope as far as headline inflationary pressures easing going forward, but we do acknowledge, particularly in the US, some of these stickier, longer-term core inflationary pressures are likely to hang around for longer than normal. As we said earlier, we don't see attraction to bond yields yet anywhere offshore, and as a consequence, financial repression tends to continue, forcing you really to own equities relative to competing asset classes in an offshore context. SA monetary policy to start tightening. I think along with a lot of people, were perhaps surprised that we had started as early as last week, saying that, if you cast your eyes across pretty much every EM around the world, almost without exception, EM countries have started to normalize their interest rates. And I think as much as our inflation rates have remained relatively low compared to offshore, I think the Reserve Bank's a little bit anxious that they've been left behind, and there's perhaps a credibility concern, and hence the start of what we would hope will be a relatively mild normalization of interest rates. The dollar remains very overvalued, as we've shown, and despite the fact that 2021 was a very strong cyclical year, even with that, the dollar remained very strong, which has been very, very difficult to square in terms of our mind. We've reduced the rand bet through an undervalued yen. So as we said earlier, we've moved more offshore. So to conclude, overall portfolio remains relatively constructive, but we have reduced our cyclical components within the portfolio. And that, guys, is the presentation in a nutshell. Appreciate it.
Great, Richard. Thank you for that, and for sharing your views on markets and kind of what you're looking at the moment and how you're responding in the portfolio. I think if you have to kind of look out over the sort of next 3 to 6 months, what would you say are the biggest risks in the market? Something that you think could trip up kind of your sort of medium-term view on markets? And could it be like much higher inflation than expected, or some sort of event? Well, I suppose an event you can never really tell beforehand.
Yeah, I think I think one of the risks, and we in a sense are starting to see it now, Craig, is the Fed in our minds seem to have woken up arguably a little bit too late in terms of these inflationary problems. And as much as and it's almost ironic that the world's fastest growing economy at the moment, the strongest economy from a consumption perspective, is one of the last countries to get out of the blocks as far as normalizing interest rates is concerned, and that's the US. And the frustration is the dollar has been so strong, almost preempting that interest rate hike before it even happens. And it almost becomes a vicious circle for lower quality emerging markets, and of which South Africa is one of them. So the world has accepted the fact that the US is going to be moving rates up, and if they move rates up, then every other currency is going to be weak, including emerging markets. So and then ironically that fuels an inflationary surge within each of these countries, because not only do we have oil prices that are elevated, but we've got a weaker currency to boot as well. So that makes things like our fuel prices higher than they otherwise should be. So kind of a long answer to you, but I think higher for longer inflation is arguably going to be very toxic for emerging markets. And that's a risk. Saying that, an upside risk could be the fact that the US bond market isn't particularly phased, and the US bond market's usually quite clear in terms of risks out there, particularly inflationary risks. And so an upside surprise might be the fact that our headline inflationary pressures that we illustrated here might ease into 2022, and that might hopefully extend the cycle as far as normalizing monetary policy is concerned.
Okay. The world markets at least seem to have moved on from COVID as a risk. I suppose the sort of unknown aspect with COVID is largely gone. And we've lived with it for 18 months now. So the fact that, well, I wouldn't say it's a fact, but it appears as if we are going into a fourth wave. Markets largely ignoring that.
Yeah, they are and they aren't, Craig. I think from a sector perspective, as I said earlier, we've sort of phased out of retailers that did very, very well in the earlier stages of recovery from COVID for two reasons. A, it looks like interest rates are going up now, and B, all this COVID stimulus has found its way into consumption within South Africa, and so quite a large chunk of our retailers are now relatively elevated pre-COVID earnings basis. So where we put some of that money, we in a sense hope that some of your COVID players, your healthcare groups, some of your hospitality groups, some of your insurance companies, which have all lagged as a consequence of COVID, would participate as we go forward. But where we are a little bit concerned is the severity of the European wave that's currently playing out. For two reasons. A lot of these European countries, particularly relative to South Africa, are well vaccinated. So by way of example, if you look at Austria and Holland as two examples, they're both well into the 60s, and yet they're getting quite severe COVID waves, and hospitalization rates are rising quite severely. So if you compare that to South Africa, which is still only in its early 20s from a vaccination perspective, there is obviously an anxiety that our fourth wave, when it comes, and it looks like it's already started in Gauteng, we may not have enough vaccination yet for us to get through a fourth wave. So more recently, as much as I agree with you, we understand COVID now, and I think the world is learning to manage it. Some of the sectors that are facing COVID from a day-to-day perspective, hospitality, hospital groups, insurance, all of these, are still quite wary, I think, for obvious reasons, because of what's happening in Europe. We haven't changed our positioning. We still like insurance companies. We still like some of the hospitality groups, but it is something that we are a little bit concerned with watching Europe play out.
Richard, thank you for your time. Thank you for coming back and completing the job. We appreciate it. And yes, I think, just in terms of our view, we do continue to use the multi-asset hedge fund as a diversifier in client portfolios. And yeah, I don't know if you were aware, but our clients have been offered the lower fee class already. So I think that was in anticipation of the flows that have subsequently arrived. So thank you from our side for your support and for being part of this.
Thanks, Craig, and again, thanks for your support. It's been much appreciated, and all the best with you and your clients going forward in the year ahead.